That's great. That's good. All right, so we are going to start with purchase consideration. Purchase consideration. So, purchase consideration. What is it? So let me. All right. So when it comes to acquisition, acquisition means you are taking over another company, right? And you do that by buying the company. Okay, buying. Okay. So there are different considerations. Okay, given to acquire a company. All right. So I mean the obvious one is cash. You can pay for with cash. Okay, you can buy the company with cash. Okay, you can also buy with what we call share exchange. Okay, so look at that. Then you can also buy with what we call deferred consideration. Okay, then um, you can also as part of the agreement you can also look at or factor in contingent consideration. Okay, contingent consideration. So we are going to take each of them and look at it in detail. All right, so cash is obvious. All right, so you want to buy a company. The let's say company A. Company A want to buy company B, and company B says we are selling company B for maybe $100,000. Then company A will pay the $100,000 with cash. Okay, and then company A will take over company B. So that's cash. That's cash consideration. Okay, now let's look at share exchange. Yeah. Share exchange is a bit um it's not straightforward. Let me see. It's not that straight, but then you can easily understand it. All right. So we have company A. We have company A. Company A want to buy company B. Okay. All right. Now company B is owned by company B has its own shareholders. Okay, they are the owners of the company. And company A also has their own owners who are called the shareholders. Now, what makes someone a shareholder? You become a shareholder if you buy shares in the company. So it means these shareholders have shares in the company. That's why they are shareholders. The shareholders in company B also have shares. That's why they are shareholders of company B. So company A wants to buy company B, but they are using share exchange. It means that company A, okay, instead of buying company B, company A will tell company B shareholders that okay, we want to take over company B. We want to take over your company, but we will give you our shares. Company A will give company B company A shares. You get so these are company A shares. Okay, so company A will say that okay, we will give the shareholders of company B our shares. so that you also become owners of company A. Do you get it? So company A will give their shares to company B, shareholders of company B, so the company B will become shareholders of company A. I don't know whether you get the idea.
I get the idea.
So it means that company B will no longer, the shareholders of company B will also become shareholders of company A. Do you get it? So it's like, okay, we are taking over your company, but we want you to become part of us. We want you to become part of our company. So at least you still get to benefit in our company. Okay, so that's the share exchange. Okay, so the shareholders will still benefit by being part of company A. That's the share exchange. Okay, then we have the deferred consideration. So here, company A want to buy company B. Maybe company B is quoting some huge amount, maybe $1 million. Okay, but company A can only pay maybe $500,000 now. Okay, company B can only pay $500 now. Okay, so company A can pay $500,000 now. So company A can tell company B that, oh, we'll pay the balance next year or next 2 years. Okay, maybe the balance is 500,000. So this will be paid maybe in the next 2 years. Okay. So therefore, this becomes deferred consideration. When the word deferred means something that is carried forward to the future. Okay. So it's like this amount will be paid in the future. So that's deferred consideration. Yeah, that we also have contingent consideration. So this looking at the word contingent. Contingent means that Michael, how do you understand contingent? The word contingent means dependent. Let me say dependent. Okay, okay, contingent upon something. So it's like before I will do something, okay, it will be based on something else. For instance, if it rains, I will not go to the market. If it rains, okay, so it means that going to the market depends on whether it will rain or not. Do you get it? So my going to the market is based on the weather. If it
So,
rains,
subject to chance.
yeah, something that is subject to something else. So that's the contingent. So for instance, you company A want to buy company B. All right, and company B probably is not making currently is not making so much profit. Okay, it's not making so much profit. So company A doesn't want to bet so much on company B because looking at how things are, they are not making profit. So company A can say that okay, right now we'll pay you maybe a certain amount, maybe we'll pay you $100,000. But if we buy company B and the company does well, okay, the company start making profit, things are going well, then we'll pay additional maybe 60,000 or 70,000 to it. Okay, so this 60,000 becomes contingent. Okay, because this one will depend on the profitability of company B after acquisition. Yeah, so if company B is able to make profit after acquisition, then company A will pay additional $60,000 to the shareholders of company B. But if it doesn't, then nothing will be paid. Okay, so that's what we call the contingent consideration. So you can see it's straightforward. All right. Okay, so we have an example here. On 1st January 2012, Prince Limited acquired 75 of the equity shares of Xavier Limited by means of an immediate share exchange and a cash payment of 2 cedis per share. The cash payment was due on 1st January 2013. The cost of capital of Prince Limited is 20% per annum. Share exchange consideration was 40 million. Xavier ordinary shares at the date of acquisition was 30 million shares. Required: calculate the consideration offered by Prince Limited. Okay, so Prince Limited want to buy Xavier Limited. Prince Limited want to buy 75% of Xavier's Limited. And what is the consideration? There are two considerations here. One is what? Share exchange. Okay, we have share exchange, and then we also have cash payment. But the cash payment was due on 1st January 2013. Okay, which is 1 year from now. The acquisition is 2012. Okay, the acquisition is in 2012, but the cash payment will be paid the following year. The cost of capital of Prince Limited is 20%. Share exchange consideration was 40 million. Xavier Limited ordinary shares at the date of acquisition was 30 million. Create the consideration. So to get the consideration, there are two types of considerations here. We have the share exchange. Now we have the cash, then the share exchange. Okay, so the cash, how much is the cash? They said the cash is 2 cedis per share. 2 cedis per share. And we need to know how many shares Prince Limited is acquiring. Prince Limited is acquiring 75% of Xavier shares. And what's the total shares of Xavier? Is 30 million. Okay, so let's calculate the shares acquired. It's 75% multiplied by 30 million. So it will be how many shares?
That will be 2,250,000.
2,250,000. Okay, shares. Okay, good. So now, so this is the total shares that Prince Limited acquired. Okay, and they are paying 2 cedis per share. Each share they are paying 2 cedis. So what's the value of the shares that Prince Limited is acquiring? So that is the value of shares. It's equal to 2 cedis. Okay, multiplied by the total number of shares. Do you get it? Because each share is 2 cedis. So how much will be the value of shares?
4,500,000.
So that's 4,000,000 five.
500,000.
Okay, good. Yeah, 1,500,000. Yeah. So this is the value that Prince Limited is going to pay for Xavier. Okay, Prince is the parent now, and Xavier is a subsidiary. All right. Now the next question is that they are saying that this amount will be paid next the following year. You see, if they are going to pay it on 1st January 2013. Meanwhile, the acquisition was 2012. So that's 1 year. So they are not going to pay this money right now. They will pay it next year. All right. So because it's going to be paid in the future, we have to look at the time value of money, or we have to find the present value of this amount. Okay, because this is going to be paid in the future. So we need to know the present value. So we need to determine the present value of this amount. So to determine the present value, it's going to be you know how to calculate present value, right? So we need the the discount factor. Okay. So that they have given us the discount factor. It says the cost of capital of Prince Limited is 20%. Okay. So our discount factor is 20%. Okay, it's 20%, and for how many years? It's just 1 year, right? Yeah, so it's going to be this over 1 plus 20% raised to the power 1, right? Yes. Okay, so how much are we going to get? Oh, 450,000, 4,500,000 divided by 1 plus 20%, 1 plus, so that will be 37, 3750123. All right, so that's going to be the consideration. Are you with me?
Yes, I'm with you.
Okay, good. Yeah, so that's how it's going to be. So this is the cash consideration. Okay, so let's continue. Now let's look at another issue. Okay, we've looked at contingent consideration, right? So I think we did not go deeper. Okay, so let's look at contingent consideration. Okay, so contingent consideration is where the company uh, agrees to make certain payments depending on the occurrence or non-occurrence of an event in the future. All right. So if a particular condition is satisfied, they will pay. If the particular condition is not satisfied, they will not pay. Okay. So contingent consideration will be in the form of a liability. Okay. It can be in the form of liability or it can be in the form of equity, depending on the agreement. Depending on the agreement. So, for instance, company A, company A, company B. Company A want to buy company B, but company B says, okay, we'll pay right now. We'll pay $100,000. Okay, but if we buy company B and company B makes profits of maybe $10,000, we'll pay additional 50,000. We will pay additional 50,000 to company B. So this 50,000 becomes contingent consideration. It means that if it means this 50,000 will only be paid when company B is able to achieve the profit of $10,000. If not, company B will not, company A will not pay that amount. Do you get it? So it becomes the contingent consideration will become like a liability. It will be a liability for company A to pay. In the consolidated financial statement, it will show as a liability. All right, but then it will still depend on whether company B will satisfy the condition or not. Do you get it? So contingent consideration must be recorded on the date of acquisition at its fair value, either as equity or liability. So it can be equity or it can be liability. It is recorded as equity when it is expected to be settled in a fixed number of the subsidiary shares. Okay, so contingent consideration can be in the form of equity. So for instance, company A can say that, okay, if you make a profit of 10,000 shares, okay, so if you make profit of $10,000, we will give you maybe 5,000 of our shares. Okay, we'll give you 5,000 of company A will give company B 5,000 of 8 shares. So that makes it equity contingent consideration. Okay, so contingent consideration can be in the form of a liability or equity. Is that clear? Does it sound clear? Or is there,
Yes.
is there any confusion?
No.
Okay, good. Yeah, okay, that's fine. So that's contingent consideration. Let's continue to um okay, let's look at an example. Company A acquired 75% shares of company B by means of immediate cash payment of 3 million cedis. So company A paid 3 million cedis to acquire company B, but it did not end there. Okay, it did not end here. But what's happening next? Company A promised to pay company B additional 2 million. You see, they also made some promises here. The additional 2 million the following year if company B is able to make profits of 5 million. Okay, so company A acquired company B, fine. Company A paid 3 million for the acquisition. Company A also made some promises that, oh, if company B is able to make profits of 5 million, we will pay additional 2 million. Do you get it? Required. Calculate the consideration offered by company A. If the cost of capital for company B A is 10%. Okay, so let's look at the consideration. So here there are two types of consideration. One is the cash consideration. The other one is contingent consideration. Do you get it? So how much is the cash consideration? The cash consideration is how much? Looking at the question is 3 million. So then the other consideration is what? Contingent consideration, which is how much? 2 million. So when you add everything together, it's 5 million, isn't it? Are we okay? But
Yes, I'm
remember,
okay.
this one we need to look at something here. This one will be paid the following year. If you look at the question, say company A promised to pay company B additional 2 million the following year. Okay. So it means they are not going to pay the 2 million right now. They will pay it next year, assuming a year.
Next year, until they've made a profit of 5 million.
Yes, even if they, yeah, until they made a profit of 5 million. So it means that this 2 million, we need to find the present value of it. Because we are not paying it now, we'll pay it next year. So we have to find the present value of the 2 million. So, and always to find the present value, you need a discount factor. So we are giving 10%. So it will be what? 2 million over 1 plus 10% raise the power 1. So this is just 1 year. So 1. So how much are we getting? Um, so 2 divided by 1 plus 10%. That's like 1.8. Good. So instead of 2 million here, okay, it should be 1.8. Okay, instead of 2 million here, this one should be what? 1.8 million. I hope you get the idea. Whenever
Yes.
the payment is going to be made in the future, remember to uh, discount it or find the present value. So we get 4.8 million. Yeah, so you can, that's how we go about it.
I had 1.1 million 818,181 point
Okay,
eight.
okay, I think it's this one, 1.8. That was,
Okay.
yeah,
Yeah.
1.8 million. So that's it. So you can see it's not difficult. And these are the things they will be bringing in the exams. So you have to be familiar with all of these things. Okay, let's look at pre-acquisition dividends. Pre-acquisition dividend. What is it? Pre-acquisition dividend. Okay. So pre-acquisition, we all know what pre-acquisition means, right? Pre-acquisition means before acquisition, before the company was acquired. Okay, pre-acquisition means before acquisition. All right, so pre-acquisition dividend. Now let's an example will help us to understand. Let's say that company B, okay, company A acquired company B. Okay, company A acquired company B on 1st July 20, maybe 2022. Okay, then 31st December, 31st December 2022, right? 2022. Okay, company A, so company B paid maybe let's say two twenty, maybe let me say 50,000 dividends. Paid 50,000 dividend to company A because now company A is a shareholder. Okay. So company A acquired company B on 1st July 2022. Okay, fine. And at the end of the year, company B paid 50,000 dividend to company A. And this dividend that was paid to company A was for the entire year. Okay, was for the what? Entire year. But remember that company A became a shareholder from 1st July. If we draw the timeline, okay, we draw the timeline. Um, let's illustrate points. So this is 1st January, 31st December. Okay, company B acquired company A acquired company B on 1st July. Okay, 1st July. So here from here to here. Okay, and I also have from here to here. Okay, this is pre-acquisition. This period is what? Pre-acquisition. We all agree, right?
Yes, I do.
And this place is what? Post-acquisition. Um, yeah. So from 1st July to 31st, 30th June, pre-acquisition. Alright, and then from here going is post-acquisition. But the dividend that was paid, okay, was for the whole year. The dividend that was paid was for the whole year. Dividend now was paid was for the whole year. Do you get it? Meanwhile, company A only became a shareholder from 1st July to 31st. Okay. So it means we have to divide the dividend that company A received into two, the post acquisition and the pre acquisition. Okay. So the pre acquisition dividend is going to be um, because company A became a shareholder from here to here. See, from here to here. But they have received some money here, which is in the form of dividend, which they did not work for or did not invest. Okay, so that is like an extra income they are getting. So the pre-acquisition dividend is going to be, we know the total dividend is 50,000. Okay, so we need to know the number of months. That's January, February, March, April, May, June, 6 months. So the pre-acquisition dividend will be 6/12 multiplied by the 50,000. Then the post-acquisition will also be 6/12. Okay, it's also going to be 60,000. So how much are we getting here?
25,000.
So 25,000. Okay. So it means that under normal circumstance, company A should have received only 25,000. Okay, because that was the period that they invested in company B. Okay, but they are getting some extra money for the period in which they were not even shareholders. Do you get it? Yeah. So this is what we call the pre-acquisition dividend. The question is, how do we treat this pre-acquisition dividend? So as you can see, this pre-acquisition dividend is like a, I don't know, it's like a free money or it's like a free cash because company A did not work for it. Okay, they did not invest. It's not coming from their investments. Okay, so it's like a bonus that they are getting. You get it. So when we are treating it, what we do is that, okay, I'll show you how we treat it. Okay, so let's look at this. Pre-acquisition dividends can be regarded as free cash. It's like some free money they are getting to the parent company. This is because it cannot be regarded as a return on the parent's investment because it relates to the period before the investment was made. See, therefore, pre-acquisition dividend is treated as a reduction in the cost of the parent investment. Okay, so pre-acquisition dividend is treated as a reduction in the cost of the parent investment. So let's look at something. So let's say company A bought company B maybe for 700,000 cedis. Okay. And company A receive pre-acquisition dividend. Company A received a pre-acquisition dividend of maybe 100,000 cedis. Okay, so company A bought company B for 700,000 and company A received pre-acquisition dividend of 100,000. So what we do is that, okay, so what's going to happen is that company A bought company B for 700,000, right? But they also received a free money of 100,000. So it means, in effect, the actual money they paid to company B is 600,000. Do you get it? They paid 700,000 to company B to acquire it, but they received pre-acquisition dividend of 100. They received money that they did not, let me say, work for. Okay, from company B. So it's like, probably, let me say, an amount that company B has returned back to company A. Okay, we can put it that way, that okay, I've given you 700,000, but I'm giving you back 100,000. Okay, do you get it? So it means the actual amount that company A paid is what? 600,000. Do you get the idea? Or you don't get the idea?
I do.
Yeah. So pre-acquisition dividend, we deduct it from the cost of the acquisition. So always remember that. Okay, let's look at purchase of preference shares. Okay, purchase of preference shares. Now there are two types of shares. We have ordinary shares and we have preference shares. Okay. Usually in acquisition, the parents purchase the ordinary shares. It's the ordinary shares that is purchased. But sometimes the parents can also purchase the preference shares of the subsidiary. Okay. Sometimes. So when there's a purchase of preference shares, how do we treat it? Okay. So when we are determining the cost of the acquisition, we also include the cost of the preference shares. Okay, so let's say the parent company bought ordinary shares of maybe for an amount of maybe 50,000. They also bought preference shares for an amount of 10,000. Okay, so at the end of the day, the total consideration will be what? 60,000. Do you get it? So the preference shares is also added to the total consideration. So let's look at an example here. So this is a past question. On 1st April 2014, HPLC acquired 4 million of the ordinary shares of S Limited, paying 4.5 cedis each. They paid 4.5 cedis each for the acquisition. At the same time, HPLC also purchased 500,000 cedis of SPLC 10% redeemable preference shares. See. At the date of acquisition, the retained earnings of S Limited were 8,400,000. Ordinary shares in issue was 5 million shares and the redeemable preference shares was 2 million cedis. Required: calculate the consideration offered. 2. Calculate the goodwill arising out of the consolidation, out of the this should have been out of the purchase, or sorry, out of the acquisition. This is an acquisition. Okay. So let's look at something here. Let's calculate the consideration for the shares. So they bought shares, ordinary shares. They also bought preference shares. Okay. So they bought 4 million ordinary shares. And how much is each share? 4.5 cedis. So let's look at the solution. So we have they bought. So we are looking at the consideration. Okay, so the consideration is two. They bought ordinary shares. And how much did they buy? They bought 4 million ordinary shares. And what is the price per each share? They said each share is how much?
4.5.
Yeah, 4.5.
4.5.
Okay, yeah, 4.5 C. So we have to
So
add it.
8 million.
They also bought preference shares. So preference shares, how much did they buy preference shares for? They bought they bought it for 50,000. What is it? No, 500,000. Okay, so that's so this one is 500,000. But here, how much are we going to get? 4 million multiplied by 4.5.
18, 18 million.
Oh, okay, 18 million. Okay, okay, so we are getting 4 million plus 18 million. Okay, yeah, we have the 18 million here. Yeah, so when we add them together, how much are we getting? So 18, 1, 2, 3. So it will be 18 million 500,000.
80 million, 50,000.
Okay, like this. Okay, so this is the total consideration they paid for the acquisition.
Sorry, 18 and 500.
Yeah, yeah, 500. Okay, so that is the purchase of So now the next thing is we have to calculate the goodwill. The question said we should calculate the apart from the consideration which you have calculated. The next thing is we should calculate the goodwill. So we have done this. We love with this. Okay, so how do we calculate the goodwill? So let's look at the goodwill. You know, the goodwill is usually the consideration minus the cost. Okay, the consideration minus the cost of purchase, or the cost of the acquisition, or the value of the subsidiary that we acquired. So our consideration, we know it is 18,500. We know it is this, right? 8,500,000. Okay, then less the net assets acquired. The net assets acquired. Okay. So how much net asset did the parent company acquire? So they acquired um look at the first one. Okay, so we need to know the net assets acquired. Alright, but before we know the percentage of net assets acquired, we need to know the total net assets of the subsidiary before we can even determine how much was acquired. So let's go back to the question and look for the net assets, okay, of S. So S at the date of acquisition, the retained earnings of S was this. So this is the retained earnings. Then the ordinary shares was 500,000 and the redeemable preference shares. So the net assets we have um, we have stated capital, which is how much? 8,400,000. That's at the date of acquisition. Then so this is a line here. Then the retained earnings. So how much was the retained earnings? Oh, sorry, this is rather the retained earnings. This one. This is the retained earnings. Then we have the stated capital. So the stated capital was how much? They said they had 500,000 shares. But how much is the price of a share? Okay, so the price per share is 4.5. Let me see. So how did I? It was Oh, okay, let me see this one. See. Okay, let's see. Okay, so the price per share was not given, but let's assume that each share is one cedi. Okay, the share for each share costs one cedi, or the value of each share is one cedi, so it will be 5 million. We are referring to this. Uh, the ordinary share in issue was 5 million shares. So let's assume each share is one cedi. So we are getting, so when we add it together, how much are we getting?
So 23,400, 23,400,000.
Hey, wait to 8,400,000 plus 5 million.
I count 8 million
Yeah, just plus it.
plus 5. That's 13,400,000.
Yeah, 30,400,000. So this is the net asset acquisition. Okay, this is the total net asset. Okay, now the question is how much of this net asset was acquired? Okay, we need to look at it. So let's go back to the question. It says that on 1st April 2014, 8 PLC acquired 4 million of the ordinary shares of S Limited. So they acquired 4 million. Out of how many shares? That will give us the percentage of acquisition. Okay, they have 5 million shares. It's here. So the percentage of acquisition will be 4 million by 5 million, which give us how much percentage? That will give us 80%. So it means um, 8 PLC acquired 80% ownership in S Limited. So in some exams or in some questions, they'll give you the percentage of acquisition. In other questions, they will not give you the percentage, but you have to calculate it, like what you have done here. Mm. So now we know the total net asset is 30,400,000. So let's come back to the net asset acquired is 80% multiplied by how much? This that's 18,100,000. They acquire 80% of this amount. So how much are we going to get?
2,412,000.
I don't know. Mm,
So let me check the percentage again.
okay, let me see.
10,720,000.
Okay, yeah, 10 million.
720,000.
Okay, so 10 million, 720,000.
720,000.
Okay, good. Yeah, so that's the net assets acquired. But they also purchased ordinary shares. So apart from this, okay, they also bought some preference shares, which is part of the acquisition. So the preference shares, how much did they buy? Okay, let's go back to the question. No, they bought 500,000 of the company's ordinary of the company preference shares. Okay, 500,000. So you have to ask yourself, what was the total preference shares of the company? Okay. The total preference shares was 2 million.
2 million.
So you may divide it by 2 million. So what's the percentage that they bought? 500,000 over 2 million. That's 25%.
25%.
Yeah. So they bought 25% of the preference shares. So you also do 25% of the 200,000. Oh, yeah, of the 2 million. It will give you the 500,000. That's it. So at the end of the day, the goodwill is going to be this minus this minus this. So how much are we going to get?
That's 11,199. 11,199,815.
Okay, let me see. No, I'm getting 7280123. So it will be this minus this minus this.
Yeah, yeah, yeah. It's 7,280,000.
Yeah, yeah. So this is a goodwill. Yeah. So when you meet a question with preference shares, that's how you go about it. So you determine the net assets, the ordinary shares. You do it separately, and you also come and do the preference shares. And when it comes to the consideration, you do the ordinary shares separately, and you also do the preference shares to get the total consideration. Okay, so this is the case of preference shares. Okay, now let's go to intra-group trading. Okay, intra-group trading, intercompany trading. Okay, so that is also an important subtopic under consolidation. Okay, so it's a normal practice that group companies within a group will do business among themselves. It's a normal practice. So we have um, this is a group of company. This is a big. The second is a parent company. It has different subsidiaries. So this is the parent, the big company, but it has subsidiaries. Now A can do business with B. B can do business with A. B can do business with D. Can do business with D. This one can do they can do business with each other in the group. Do you get it? So now when we are consolidating, we have to make sure all intercompany balances are taken out. Okay. So for instance, A has given loan to B. A has given loan to B. Okay, let's say yeah, A has given loan to B of maybe 100,000. So A will record an asset. A will record an asset because when you give loan to someone, you record it as assets. So A will record assets of 100,000. Okay. Now B received the loan. So B will record this as a liability. Okay, because now B has to pay A. Okay, B will record it as liability. Okay, so when we are consolidating, okay, this will cancel this. You get it? Because they are all in the same group, so they cannot owe each other. Okay, so if they are owing each other, we take all the intercompany balances out. Okay, that's a major principle under consolidation. Okay, if there are any intra-company transactions and balances, we take them out when we are consolidating. Okay, so mostly in exams, the intercompany transaction you will see is a sale of goods. You will see that they will say the parent sold some goods to the subsidiary, or the subsidiary sold goods to the parent. You also see something like loan. You will see that the parent has given loan to the subsidiary, or the subsidiary has given loan to the parent. Yeah, you will see something like that. What else do you see? You also see, um, I think these are the key main things.
So with Papa, what are the new topics that they've added to?
So financial reporting.
Yeah.
Oh, financial reporting. They did not add any new topic. So it's good. It's the same topics. Okay. Another issue is sale of non-current assets. The subsidiary can sell a vehicle to the parents. Okay. The parents the parents can also sell a vehicle to the subsidiary. Okay. So this. Okay. Now let's look at sale of goods. Okay. So we have parents. We have subsidiary. Now Parent has some goods. The cost of the goods is 10,000. This is the actual cost. But they sold it to the subsidiary for how much? Maybe 20,000. Right? They sold it to the subsidiary for 20,000. So there's a profit of how much? 10,000. Do you agree? Hello?
Yes.
Yeah, there's a profit of 10,000. Now, the issue is that parents parents have sold the goods to the cost of the good is 10,000. They sold it to subsidiary at 20,000. They have recorded a profit of 10,000. Okay, now the question is, if you are a parent and you sell goods to a subsidiary, you have not you have not made any sale yet. Do you agree or you don't agree?
As with that, we have not made any sales.
Yes, like you are a parent, you have
Yeah.
sold 10,000. You have goods of 10,000. You sold it to your subsidiary for 20,000.
Yeah, I agree because the person is still under you, or you are the parent, and it's a company that is under you that you are controlling.
Okay. Yeah. So let's say that we are a family. We are a family. This we are all in this box. Okay. We are in a family. So in this everything that happens in this family is affects all of us because we are in the same family. Okay, so the parent is here. The parent has sold goods to the subsidiary and the parent has added profits of 10,000. Okay, and so the parent is making.
The, the, the difference of 10,000 becomes goodwill, or
Oh, we have not gotten there yet. Mhm. So um we are in the same family. Okay, parent has sold the goods to the subsidiary and it has made profits of 10,000. Okay, now the issue is that this 10,000 is not going to be or it doesn't change the value of the what's the name? It doesn't change the value of the group. Okay, because if if the subsidiary is paying the 20,000, it's affecting the subsidiary. I don't know how to. The subsidiary is paying 20,000 to the parents. So at the end of the day, I mean, nothing has happened. Okay, the money, whatever belongs to the subsidiary belongs to the parents. Okay, whatever belongs to the subsidiary, it also belongs to the parent. So if I've sold goods to you and you have used my own money to pay me back, I mean, that nothing has
it's
happened.
a very good. No, that's me.
Do you get it? Nothing has happened because whatever belongs to the subsidiary is for the parent. So I'm so good to you. You have used my own money to pay me back. And I'm not getting any profits. Okay, do you get it? So when parent sells goods to the subsidiary or subsidiary sells goods to the parent, nothing has happened. Now, something happens when the subsidiary sells the goods outside, outside of the group to someone who is outside of the company, and the person pays the the goods. So let's say when the parent sold it to the subsidiary 20,000, so subsidiary also sold it to someone who is outside the group for 20,000. Okay, in this case, this there's 10,000 coming back to the group. Okay, there's 10,000 coming back to the group. So now the group is going to benefit, or the value of the group will increase by what? 10,000. Yes, because this money is coming outside to be added to the group. They get it. So the bottom line is that when parents or subsidiaries sell goods among themselves, nothing happens. Okay, it is only when the goods are sold to an external party that is when the value of the company increases or is affected. They get it. Yeah. So that leads us to what we call unrealized profits. Okay. So when you hear unrealized profits, it's a profits like this profits that the parent has made for selling to the subsidiary. It's called unrealized because it's still within the group. Nothing has happened. But if the subsidiary sells these goods to an external party and the external party pays the money to the subsidiary, okay, then we can say the profit has been realized. Do you get that idea? Yeah. So that's what we call unrealized profit. So in exams, you come across unrealized profit. Okay. So let's look at an example. Example help us to understand where can we to get past first. Mm-mm. Okay, let me look for a past first. Okay, we have a question here. Okay, so we have two companies, Stocky Limited and Funny Limited. So who is the subsidiary and who is the parent? So let's find it here. Stocky acquired 30 million ordinary shares of Funny Limited on 1st January. So Stocky is the parent. So because they acquired Funny Limited. So Stocky is the parent, Funny is the subsidiary. But we are jumping to the intra-group transactions. Okay, which is here. Okay, during the year, Stocky Limited sold goods worth 25 million to Fanny Limited and made a markup of one third in arriving at the selling price. At 31st December 2020, inventories of Fanny Limited included 4.8 million in respect of the goods supplied by Stocky Limited. At 31st December 2019, Fanny Limited inventory included 3 million worth of goods purchased from Stocky Limited at the same markup on cost. Ignore deferred tax implication on these items. Okay, so we are not looking at this. So these are intra-group transactions. Stocky sold some goods to Fanny. Okay, so let's look at. So this is a typical exams question. So this is Stocky. Is a parent. This is a parent. They sold goods. They sold goods towards Fanny. So what is the cost? You should always remember the cost of the goods and the price. Okay. Sold good worth 25 million. Okay, to Fanny Limited and made a markup of one third in arriving at the selling price. So they sold it for 25 million and the markup on the goods is one third, 1/3. Okay, so selling price. The selling price is 25 million. Okay, let me sold goods worth 25 million to Fanny and made a markup of one third in arriving at the selling price. Okay, how do you understand this? Now, this is where I see a confusion is. How do
He said, during the year, Stocky Limited sold goods worth 25 million to Fanny Limited and made a markup of one third in arriving at the selling price. And that means there was a profit, there was a amount of one third in addition
okay,
of the selling.
okay, yeah. So we need to. So Stocky sold goods worth 25 million. Okay, worth to Fanny Limited and made a markup of one third in arriving at the selling price. Okay, so
So the markup of one third will be added to the 25 million to be
yeah,
the selling price.
okay, yeah. So yeah. So the markup, markup is on the cost of the item. So when you are selling something and you add a markup to, so let's say if you are selling something and the cost is maybe 1,000 cedis and you add a markup of maybe
So the
20%.
markup becomes the selling price,
Okay, so the markup becomes the profit.
the profit. Yeah.
Okay, so at the end of the day, your selling price, okay, is equal to the 10,000, the 1,000, which is the cost, plus the 20% of the 1,000. Okay.
That is 200.
and that's 200. So your selling price will be what? 1,200. So it means that even though the cost is this, you are selling it as this. So you are making a profit of 200, 200 cents. Yeah, so that's what it means. So always when it comes to markup, we need to find the cost first of the item. So the cost of the item is 25 million because say stock is so goods worth 25 million. Okay, so that's the markup. So that's the cost. Okay, so I see they like confusion. So you have to so the
Yeah,
cost
so if we don't solve all questions, we know all the those confusions.
yeah, you go and meet something like this, you wonder what's going on. So the cost is 25, that's the cost. Okay, and then they added the markup of what 1/3. 1/3 is 1/3. So 1/3 is how much? 1/3 is so it means the markup is going
Eight
is going
million and 33, 8,333,333.
hey what are you saying?
I was calculating the markup on the 25 million.
Okay, yeah. So 25 multiplied by 1/3.
Should I ignore the six zeros?
Yeah, we are just using we are just using the full. I mean, we are ignoring the zeros. Okay.
Oh,
So
okay.
the markup is going to be 8. Okay.
It's 8.3, but eight is okay.
Yeah. So the selling price will be 25 plus 8 will be 33. Okay. So they sold it for 33 million. Mm, 33 million. Okay, fine.
So in the exams, sometimes you have to ignore the decimals. Eh?
Oh no, you mean okay? It depends on the number of zeros you are working with. Here we are just working with the whole numbers. That's why I just wanted to focus on. But in exams, you have to to be on the safer side. You can include the decimals in order to add to two decimal places, just to be on the safer side. But it all depends on the figures the decimals you are working with. Okay, so that's the selling price. So at 31st December, inventories of Fanny Limited included 4.8 million in respect of the goods supplied by Stocky Limited. Okay, okay, so it means that um, at the end of the year, Okay. So it means that Stocky, who is the parent, sold goods to the subsidiary for 33 million. Okay, there's the price. That's how much they sold the goods for. Okay. So this 33 million at the time of sale is unrealized. Okay, because once you sell goods in the group, nothing has happened. It will only be realized when it is sold outside the the group. Okay, so we have to check whether the subsidiary has sold all the goods or not. If the subsidiary has not sold all the goods, then it means there will be an unrealized profit we have to deal with. So at the end of the year, Fanny Limited has sold all the goods that it bought from um, the parent company, but there's still a balance of 4.8 million in respect of the goods supplied by Stocky. Okay, so Stocky, the goods that they bought from Stocky, there's still a balance of 4.8 million. So there's still an unrealized profit in this amount. Okay, so we need to calculate the unrealized profit. So to calculate the unrealized profit, we need to know the goods in inventory, which in this case is 4.8 million. Okay, now let's calculate the unrealized profit. Okay, so now the markup on it is one third. Let me see, that's one. Let me see, one third. The markup is one third. So markup is on the cost. So how do we even go about this? Let me see, let me see, let me see. So there's markup is 8 million. Let's see something. So if I want to get the markup of this, let me see. So 33. Let me see x times 3x. Give you let's see if I want to find. So let's see. So if I want to, hello, Mike. Are you there?
I'm here. Oh, I'm here.
Okay, all right. So I'm trying to figure out something,
Okay.
and
All
just
right.
yeah. So just a minute. Let me say something here. So this 25, 1 25. So I can say if 25 8 and 4.8 will be markup of less if minus 24 over 25 times 8. Now 1.536. Okay, 1.36. Let me see something. People are giving me headache. Unrealized profit. Wait, what? How did they get? On year end inventory 104 4,800. Okay. Mm, but this 1/4. 1/4 or 1/3. In fact, let's move on. This question, I don't know why it's confusing. Okay, so let's look at an example here. So let's say parent company A sold goods to subsidiary B for 5,000 cedis. The markup on the goods is 25%. Okay, the parent company, which is A, sold goods to subsidiary B for 5,000 cedis. There is a markup of 25%. Okay, explain the transaction, how the transaction will be accounted for. Okay. So when you see a markup, it means that the profit is before arriving at this 5,000. Okay, they have already included 25% of the cost of the material as a profit in order to arrive at the 5,000. So if you see this 5,000, it means we have the cost and then we add 25% of the cost, okay, to get that 5,000. Okay, that's a what?
So if you want to know the cost, you have to deduct.
No, if you want to know the cost, okay. So let's do our math here. Okay, so the selling price is, we're told that the selling price is 5,000, but there's a markup of um 25%. Okay. So what it means is that before they arrive at this 5,000, there was a certain cost. Okay, we don't know, and they added 25% of the cost as a profit. Okay, so 25% of what we don't know. Okay, to get this 5,000. So in mathematical terms, we will say that let x equal to cost because we don't know the cost. Okay, so to get the x, which is the cost, it is x plus 25% of our x, which gave us our 5,000. Okay, so how do you find x? This is x plus 25 is the same as 0.25 equals to 5,000. So x, this is 1x plus 0.25x, it will be 1.25x. It will give you 5,000. So at the end of the day, our x is equal to 5,000 over 1.25.
1.25.
So how much are we getting?
5,000 divided by 1.25. I'll give you 4,000.
Okay, so it means that the cost of the item was 4,000 cedis. Okay, and they sold it for what? 5,000. So it means they added a profit of 1,000 cedis to it. Do you get it? Mm.
Yes.
Yeah. But in exams, if you want to go straight to the point, if you want to get the 4,000 directly, okay, you just do I mean, you do 5,000 over 25 over 125%. Here is something. Let me see. 5,000 and 25 divided by 125. Okay, so this will give you the profit. If you do 5,000 multiplied by 25 over 125, you get the profit. Okay, the profit is the 10,000 minus the the profit is the 4,000 minus the 5,000. Okay, so in exams, okay, if you are given, usually what we are interested in is the profit on it. Okay, is the profit that we are interested in. So if we are given 5,000 here and we are giving markup of 25% and you are asked to find the profit, okay, it will be 5,000, okay, multiplied by the 25%, just bring the same amount here, okay, and divide it by 100 plus 25%. So always there will be 100 here plus 25, which will give you 125. Okay, so and that will give you 1,000. Okay, which is our profit. Assuming that this 25 was maybe 30%, okay, it would have been 5,000 multiplied by 30 over 130. Do you get it? So this is 100 plus 30. If this was 4,000, it would be 5,000 multiplied by 40 over 140 to get your profit. That's the markup. Do you get it? Is it confusing?
Yes, man. I do.
Yeah. So that's how we determine the profit. Okay. So let's continue. So gross salaries. Okay. So that's the markup. Okay. Now, when you are consolidating, another issue is that you know it's the parent that sold the goods. Okay. The parent sold the goods for what? 5,000. And then the subsidiary bought it for how much? The same 5,000. Okay. This is the purchase. This one they sold. This one they what? They purchased. They get it. So when we are consolidating, the parents will initially recognize revenue. Okay. And then because they are selling. And the subsidiary will record cost of sale or purchase because they are buying. Okay. So when we are consolidating, we have to deduct this from revenue. Okay. So when we are consolidating, we we have to take this 5,000 out of revenue of the parents. Okay, and then we also have to take this 5,000 out of the purchases of the subsidiary because they are intra group transactions. You have to take them out. Do you get it? Yeah. And let's look at the unrealized profit. Unrealized profit refers to the profits on the goods that the subsidiary or the parent sold that has not been realized. So if parent company sells goods to a subsidiary for maybe 2,000 and the profit on it is maybe 1,000, okay, and the goods has not been sold, the goods has not been sold at the end of the year. This becomes what? This 1,000 becomes what? Unrealized profit. Okay, let me take it again. Unrealized profits. Okay, now parents have sold goods to subsidiary. Okay, and the cost of the goods, the actual cost is maybe 1,000, and they sold it for maybe 1,500. So there's a profit of what? 500. They sold it to the subsidiary. At the end of the year, the subsidiary has not sold any of the goods. You see, so these goods will still be in the inventory of the subsidiary. They've not sold it; it's still in the inventory. So what will happen in the subsidiary inventory? Okay, assuming that this is the subsidiary inventory, this is the subsidiary balance sheet. The subsidiary is going to record inventory of how much? Okay, this is current assets. The subsidiary is going to record inventory of 1,500. Do you agree? Because they have not sold it. It's still at the end of the year. It's still there.
It's still in the inventory. It's still in the inventory.
So they will still, assuming that this is the only inventory left. Okay, so the subsidiary will record inventory balance of 1,500.
500.
Okay, but remember that um, as far as we are concerned, okay, the actual cost of the inventory was 1,000. You see, do you get it? The parents sold it to the actual cost of the inventory was 1,000. Okay, and then the parents sold it to the subsidiary for 1,500. So as far as the subsidiary is concerned, they record it at 1,500 because that's how much they bought the inventory for. Do you get it? Yeah, but it is not correct because this 500 here is just a profit on it. Okay, the actual inventory is 1,000, but the parents, because they want to make profit, it added the 500 to it. So this 500 is what is profit, but not actual inventory. Do you get it? Actual cost of the inventory.
Yes, I get.
Uh-huh. So when we are consolidating, we have to remove this 500 out because it is not the actual cost of the inventory. Okay, we have to make it 1,000. It should be the same as the original cost to the parents,
Parents, yeah.
because we are in the same company. So we cannot inflate we have to use the same, this
Have to use the
inventory,
right figure.
and we have to use the right figure. Whether the inventory is with the parent or the subsidiary, it's the same thousand, it's the same cost. Okay, but here it became 1,500 because the parents sold it to the subsidiary, but it doesn't change anything. It should still be what? 1,000. When we are consolidating, it will be what? 1,000. Okay. So the 500 here is called unrealized profit. Okay. So when you're consolidating, any unrealized profit will be deducted from inventory. Do you get any profits on the inventory will be taken out? Do you get, because it is not the real value of the inventory. Do you get it? Now remember that inventory is connected to cost of sale. Do you get it? Inventory and cost of sales are connected because cost of sale is equal to opening inventory plus purchases minus closing. Do you get it? So whatever we do to inventory here, we have to do the same to what? Cost of sale. Okay, so if we are taking the 500 civics from the inventory, we should do the same to cost of sale. So the inventory, we credit it by 500. Okay, we credit it by 500. No, inventory is an asset. So if you want to take out something, you credit it. Then we have the debit cost of sale of what? 500. Do you get it? So when you are dealing with unrealized profit, you deduct it from uh, inventory, then you add it back to what? Cost of sale. Do you get it? Remember it because this one it always comes under consolidation. So you need to know how to deal with it. All right. Okay, so I think we'll end here so that uh, as we take so long, then the mind becomes so hot. So at the point we need to just break and go and relax.
Mhm.
Yeah. So
Okay. No.
yeah. So uh, just go and practice. Go and
All right.
solve more
Okay.
questions on this, and you'll be fine.
All right. Okay.
Okay. Okay. So